Good evening. Kia ora. Ngā mihi nui ki a koutou, tēnā koutou, tēnā tātou katoa. No mai, haere mai. Welcome to this Mindful Money seminar. I'm Barry Coates. I'm the director of Mindful Money. And tonight we're talking about the investment fundamentals, what you need to know in order to invest. And I'm joined tonight by Tom Hartmann, and I'll introduce Tom in 1 minute. But before then, just to say, this is we're counting up the 15th, I think, seminar in our online weekly series. But just to give a heads up, next week, we are no longer on at 7 p.m. on a Wednesday. It's shifting to 5 p.m. And that's because we're doing a face-to-face conference. We're holding it at KPMG in Viaduct Harbour in Auckland Central. And we're really looking forward to a great event. We're going to be talking particularly about two aspects. One is investment action on climate change, and the other is to, in a way, continue the conversation from tonight to talk a little bit more about educating and engaging the public. So please join us at 5 o'clock next week rather than 7. We'll be sending notes around on that. And if you're in Auckland, do come along to the conference. We're allowed to do that in level 1. Their sort of face-to-face conferences are back on the agenda. And it would be great to see you. Tickets are available from Eventbrite, $30, so help us defray the costs, and also available from Mindful Money's website. So looking forward to that, and I hope some of you can come in person and others can check in online. Without further ado, I would like to introduce Tom Hartmann. Tom's managing editor at the Commission for Financial Capability, which you're going to hear us talk about CFFC. And he's also managing editor at the very popular Sorted website. So Tom's focus is on helping New Zealanders prepare for their future lives beyond work, continually developing the Sorted ecosystem of websites. I like that term. The tools, the programs, and publishing. There's a background in journalism and financial services, and his work supports the work of the Retirement Commissioner, Jane Wrightson, who, by the way, is talking at our conference next week. And he supports the Commission for Financial Capability more widely to lift financial capability in schools, workplaces, and communities. So, Tom, very warm welcome.
Thanks very much, Barry. It's great to be here with all of you.
Yeah, always nice to see you. And Tom and I get together from time to time, but he's coming to us from the Wairarapa, so we enjoy seeing you when you're in Auckland.
Thank goodness for modern technology. It's great to be a part of this.
Yeah, no, it makes it easy, doesn't it?
Yeah.
Tom, can we kick off? The whole concept of financial capability is really central to the Commission for Financial Capability, but I think it's not necessarily well understood amongst the public. They sort of sometimes get their head around financial literacy, but financial capability is different. Can you talk us through that, and in a way why the choice of that terminology?
Yeah, so there have been different terms that have gone in and out of vogue, and it started a bit more with financial literacy because it was compared, money skills were a bit more compared to the knowledge that people have in this space, and there was a drive to increase the knowledge. But we soon became aware, and I think around the world, people working in this space became quite aware that it just knowing the right thing to do is definitely not enough. There's this huge gap that we know about between knowing the right thing and actually doing it. And with money, because it's so hands-on, so tangible, we are actually talking about capability now, which is the skills you have in making money decisions. And the Commission for Financial Capability, it's really important to know, is actually, as you mentioned, the Office of the Retirement Commissioner. And once upon a time, we were called the Retirement Commission. Then we had this really long, drawn-out name, which was the Commission for Financial Literacy and Retirement Income, and that was a mouthful and a half, and we lost people at the word commission. Now we just go by CFFC, which is the Commission for Financial Capability. And financial capability is really an interesting space to work in, but it's good to define it a bit. Maybe I'll just touch on that briefly, Barry, if that's that's
go for it, Tom.
Because money tends to touch everything in our lives, or most things, and we all have an experience with money. We all sort of bring our own experience and our own baggage, if you will, to this idea of financial capability. But the funny thing is if you go around the world and you'd ask people to identify other people who are good with money and why they were good with money, you would interestingly find very similar traits, and people identifying very similar traits. And in fact, the study was done in over 70 countries, and they identified 4 main areas that mark someone who is financially capable. And the first one, is probably kind of obvious, where, financially capable people are those who can exercise some spending restraint. Their spending is not totally out of control. They're able to, they're not buying things that they don't need, or they can't, that is beyond their reach. And they have a restrained use of, consumer credit and borrowing. So no surprise there. Another area is people are financially capable when they're active savers. They save regularly. And people might also say that financially capable people are those who, typically plan and monitor. They plan their use of income, they have spending plans, and make sure that they're tracking their expenses to keep to the plan, and they're keeping track of their money and which way they're headed. But the fourth thing, and I think is really related to our conversation tonight, is really about making informed financial decisions and choosing products well. And so that means staying informed, considering your options, comparing, checking things like disclosures, terms and conditions, understanding, the product and whether it's fit with what you need. And also in there is an understanding of risk. So these are some of the things that possibly we'll talk about later. But the other important thing that I wanted to mention, at the risk of getting on too long, is why we at the Office of the Retirement Commissioner got into financial capability. Because there are many people working in financial capability, really great people who, for example, want people to lower their dependency on debt or something like that. What do we want at the Commission? What we're after is really long-term well-being. So we are working in financial capability in order to promote long-term planning, particularly for retirement, as you can imagine. And what we're looking for is financial capability in order to promote long-term well-being. So somewhere along the way before I joined CFFC, somebody came to the great conclusion that if you want people to be in the best possible position by the time they reach retirement, you have to start way earlier, which is the reason why today, for example, we have the whole sorted suite of programs, that ecosystem that you referred to there, whether it's online or in workplaces or in the communities. But we also have the Sorted in Schools program, which over the past year and a half has really exploded in terms of the uptake. I think the latest stat is somewhere around 62% of schools across the country, picking up our programs there. So we know we have to start early, and we know, especially in the investing space, the goal is to really take advantage and harness that power of compound interest, of compounding returns over time, in order to get people to the best possible position by retirement. and then to also in the investing space to manage their investments for regular income in order so that they can manage what very often can be 25 or 30 years of retirement. We're recommending people to plan for because of increased longevity.
So thanks for that, Tom. I think that sort of lays out the territory really well. One of the things I really like about the work of the Commission is the work on financial inclusion with those who are more disadvantaged. And obviously there's an ecosystem out there of budgeting services, of programs like Ngāti Ngāta that can roll up debt and make it into a manageable package that people can start to pay off. So different areas of how the financial system can be made fairer. And it seems to me like that's a pretty crucial part of the Commission's work.
Yeah, that's a fair point. We are very much the backbone organization for the national strategy of financial capability. And some years ago, even the government came out with an official statement about the importance of financial capability across the sector. So there are many, many players in this space who we collaborate with. In terms of our work on Sorted, we're very focused at an audience that is typically disengaged with their finances. And those are really our target audiences, whether it's people just starting out and saying first jobs and in just flatting for the first time, starting to make big decisions with their money and put in regular routines and habits, and particularly overstretched families, who because of all the push and pull of everyday expenses of raising a family, find themselves not so engaged with their financial situation, and especially for the long-term, their long-term outcomes and well-being.
Yeah, seems like some of those people maybe are not so much disengaged as just kind of frozen in the headlights and really worried about their financial situation and not quite knowing how to get on top of it. So anyway, let's move on. You referred to the kind of things that people should know. And I guess there's two aspects of this. One is the kinds of things that people should know financially for their financial situation. And then maybe I'll add a few things about what they should know about where they're investing and what the consequences are of that investing. But do you want to kick us off on from your perspective, where are some of the gaps? What do people often not know that they should know in the investment fundamentals?
Yeah, thanks, Barry. So we have a lot of people who are just, especially in lieu of the pandemic, have really just started out investing and investing beyond KiwiSaver in particular. And as they run, for example, to get into shares, there's a lot of people who are experimenting with trading, with all sorts of. Our role is really to try to ask some strategic questions ahead of time to really set up the framework so that people, as they start picking products, investment products in particular, in order to achieve something, that we have some principles in place, that they're principle-based investing, that they're doing it safely, and that they're working backwards from their goals. And so there's a couple guides, particularly on Sorted investing basics, which is really the fundamentals, and it's sort of like a group of principles to come back to regularly and to review regularly in order to make sure that your investing is really fitting your needs, and that you're not just running, for example, to pick Tesla, or because it's the latest flavor of the month, or picking a certain fund because you heard it's right. So what are the criteria to use? So if I go to those principles for a second, what are those, those basics that we want to repeatedly come back to? and these are based on conversations we've had with the industry and investing experts here. And we asked them, what are the most important things that you want new investors to really understand as they get into and start comparing and choosing products? The first one is to be clear and realistic about what you want to achieve. So this is really the goals-based investing. So if you think about financial goals, like if you're saving for a car, buying a house, or saving for retirement, it really helps to ask, what goal will my investing help me achieve? And then we're really encouraging people to set goals, not just for the short term and the medium term, which is 4 to 9 years, but those long-term goals to get in there, because our brains are more attuned to those short-term needs, and those short-term goals are easier to set sometimes. But it's really, if you have some goals in the short, medium, and the long term, it's quite helpful. And so that way, if you start from your goals and work backwards, you can invest in a way that helps reach those. And you can pick products and classes of products that make sense for those goals. So for example, if you're investing in shares, it's probably not something you want to be investing in for the short term because of the ups and downs in the market. So that's the first one: be clear and realistic about what you want to achieve. The second really has to do with that due diligence, doing your homework, and that's research, compare, and review choices. And on Sorted, we've got a couple of tools and platforms on Sorted: the KiwiSaver Fund Finder, which is really for choosing a KiwiSaver fund, and Smart Investor, which includes both KiwiSaver managed funds and also share and bond offers when they come online. So there's a lot of ways to compare there, to review the products, to get all the documentation that comes with them. And then you can really, do a deep dive and understand, what you might be picking. The third one is this all right, Barry? We'll just keep, I have a few to go through, but let me know if on the right track here.
Let's kind of, if you can keep it a bit short, that would be great, because then we can move on to a few other things. Yeah,
and I invite people, if they want to unpack these further, to really come on Sorted. We've got some guides there for you to come back. But the other one is really has to do with strategic asset allocation. When people pile into shares these days, I really try to encourage them, and we do in our work, of trying to ask the question, well, how many shares are you really looking for in your overall portfolio? What is the mix? Because that mix of investment, that strategic asset allocation, really drives your results with investing. So, so if you're a balanced investor, you'd be typically looking for, half shares, half bonds, is that classic 50-50 split. But that really drives what your results will be, and what your goals, how it aligns with your goals. Another one is that balance between risk and return. And by risk here, really, we define it as the chance that you might not reach your goal, and what are the risks that come with each kind of investment. And knowing those, that lots of times risk just gets talked about in terms of volatility, but there are many risks that come with that. And knowing those, helps you gauge on what the returns might be and what that balance might be. One of the last ones then is not putting all your eggs in one basket, which is all about diversification. And I know Mindful Money has just is in the process of adding, besides KiwiSaver funds, managed funds in general, which are aimed at really having a level of diversification. But many people running into shares these days, it would be impossible to be diversified enough if you're all in the same industry or geographical area. And finally is that just understanding about growth and compounding, how investments work over time when you're drifting regularly into that, harnessing compound interest for your long-term goals, and choosing products accordingly. So maybe I'll just leave it there, Barry, on these fundamentals, the principles that we're trying to get across as people start their investing and come back to it regularly.
Yeah, and I think sort of where mindful money comes in is we sort of dovetail alongside that. Well, where does your money go, and what happens to your money? Sort of what does it do in the world? What are the consequences
Yeah.
of your investment? And I think that's, in a way, it's a different take on the financial decision making, is to say, well, the way you use money has consequences,
Yeah.
and uh, so on the Mindful Money website, you get to see where your money is invested on issues that the public may be concerned about. So on weapons and on fossil fuels and uh, products tested on animals and human rights violations, etc., gambling, pornography. So these are all areas that the public says we don't want to put our money into these areas. So those are some things that we track to say, well, how much of portfolios are in there. And for example, from KiwiSaver funds, there's $4.3 billion in areas that most New Zealanders say they don't want to be invested. So there is a real issue, and one of the things that we offer is the insights for people to be able to visit the website and take a look at where their money is invested. But beyond that is the perspective that they can choose a more ethical fund. And as you say, it's possible to get this diversification across a lot of different companies. So it's less risky than investing in just a few companies. So you can get that diversification, but you can get it within a combination of companies that have high ethical standards. And that's kind of what we are able to basically give people guidance of on our website. So I think it's quite nice. I mean, we use the Sorted website a lot, and it's fantastic, and in a way where we see the Mindful Money is picking up on that and being able to introduce another element of ethical standards or sustainability or impact. It's that sense of saying, so what are the results of our financial decision making in terms of how they affect the environment and how they affect other people? So I think that it works pretty well together. Tom, I'm going to sort of open up for questions in a minute. For everyone, please feel free to go into the chat on Zoom. We've been rather authoritarian and we've muted people, but if you put your questions into chat, then we'll have a discussion based on the questions. And similarly, if you're on Facebook Live, then put any questions that you have into the comments section, and we'll be able to have a look at those questions. My colleagues feeding stuff through from Facebook. So while we've got some stuff coming in, Tom, just let me ask a little bit about one or two of these areas. One area that I think people feel quite strongly about is the whether you invest in funds. So you're investing in a managed funds or an investment fund or a KiwiSaver fund. Do you pick the one that's got a really good track record of past returns? Because then you kind of figure that they know how to manage the funds, or is that not a good basis for your decision making? Do you want to kind of lead people through that?
Yeah. So, in terms of KiwiSaver or other managed funds, really we have a hierarchy of criteria in terms of choosing which one's right for you, and performance. What you're mentioning there, which it's really important to note that this is past performance. If you are picking just based on past performance, you're chasing something that's already gone, that is past history and will not continue. It'll be different. It could be better. It could be worse. The odds of it being exactly the same are very low. And so what are those criteria? The first one is the level of risk. And so we try to, we have a tool called the Investor Kickstarter, which is basically a profiling tool that tries to help you understand what type of investor you are, whether you're, for example, more defensive or conservative, or more aggressive and more towards growth, or you're right in the middle and being balanced. That's probably the utmost decision to make first, to understand whether you're looking for a balanced fund. That's really the amount of risk that you're taking on. Secondly is to look at fees. Third is to look at the services that the provider offers that come along with that KiwiSaver fund or managed fund, which is how well they communicate and what help they give you and things like that, which we give some help on. And finally, just in terms of performance, the only thing that we can really say about past performance is to look for funds that haven't consistently underperformed their peers. And in our case, we compare it to the average for the same type of fund. So if you're looking for a balanced fund, it would be to look for a balanced fund that hasn't consistently underperformed all the other balanced funds. And this might be, it might be a sign of poor management. But that's pretty much as far as we can go in terms of the way we look at performance in your decision making.
Okay. So got questions coming in. Thank you, Mary Beth, who's saying, so when's Mindful Money putting up managed funds onto our website? So as many people know, we kicked off the Mindful Money website a year ago, and we've just celebrated our first birthday. Yay. So now we're and there's 270 KiwiSaver, actually 280 KiwiSaver funds on our website at the moment. We're just about to put up 400 investment funds. And these are non-KiwiSaver funds that are kind of pooled or managed funds that are typically quite widely diversified and managed. Now, Mary Beth is saying, when are those going up on the website? Well, we're on testing process right now.
Okay.
And we're having a lovely time of it, as we all do in the last stages of testing processes. But we think that on Monday morning, you're going to be able to open up your Mindful Money website, www.mindfulmoney.nz, and you're going to be able to look at both KiwiSaver and those 400 managed funds. And there's some really interesting ones, and particularly interesting from our perspective, from the ethical point of view, that actually there's a variety of strategies in there. There's some good funds on issues like climate change. There's some good funds on kind of engaging with companies to make them better, etc. So we're getting really excited by this launch. And so the answer, Mary Beth, is Monday. She also asked, and as does Jason. Hi, Jason. Great to have you on the call. It's about the question of term deposits or investing in shares and bonds. So Tom, when you were talking, you talked about getting regular income from investments. So can you talk to us about, in these days of close to zero interest and very little interest on term deposits, can you talk to us about what that income derivation is and what the options are? Is it dividend funds? Is it bonds?
So this is actually one of the challenges of retirement planning, because typically, on the investment side, that's what we call the accumulation side, where you're investing before you retire in order to build up and to get the most growth as possible. But afterwards, you quickly find that in retirement, what you're really after is a steady income that's not there anymore because you're not working. Now, NZ Super, of course, is there, the government pension, and it provides a floor that keeps a lot of people out of hardship, most retirees. But above that, in order to have a lifestyle that requires a bit more than that, you need to be investing for income and managing for income. And so that's what's called the decumulation phase. And investments there are typically more conservative and more defensive, and they are more about living off of dividends. But it does depend on how soon you plan on using that money in retirement. And so in terms of regular income, many people are managing through their KiwiSaver these days. There's no requirement to get out of KiwiSaver once you hit 65, and so they're staying in. They can manage. They can invest in more defensive funds, which essentially are in term deposits and cash funds, but they're managed a little bit in a different way. They tend to get a little bit better results than this low interest environment that you mentioned, Barry. But also sometimes in retirement, you might be investing for later in life. Your time horizon might be much longer, and so you might be in some growth assets still because your time horizon is say 15 or 20 years away. Okay,
good. Thank you, Tom. We've got a nice question, I think, a really insightful question from Margaret Gordon. And Margaret asks about diversification strategies, particularly geographical basis of diversification. And she says, as you get older, you haven't always got the luxury of waiting around to the right time as to sell funds. And that's potentially particularly a problem with international funds where you often find exchange rate movements that are at least as great as share market movements. So if you're having exchange rate changes that are quite dramatic, it can really affect the value of your investment. And so Margaret says, is there not a strategy to say, as you get older, maybe you should denominate more of your investment in New Zealand funds? I guess you could also say in hedged international funds, but in New Zealand funds as opposed to foreign denominated funds. And I think it's also related to the fact that most of your costs, particularly as you age, are local costs, and therefore you're kind of matching your shares and your income to your local situation. What do you think of that approach?
Yeah, so a couple of things to know here. The first off is you're right. There's a lot of fluctuation in both of those things, whether it's the value of the units overseas, but also the value of the currency when you're. But that really only matters when you're about to use the money, and so that's one thing. But the other thing is that a number of these funds, not all of them, but a number of them do hedge for currency changes. And so this is a type of currency risk, again, risks that chance that you might not meet your goal, the money might not be there. In order to mitigate that risk, many fund managers hedge their funds and mitigate that risk that way. So if you come on Smart Investor, our platform, you can see actually as it identifies the given funds that do hedge, and you can talk more to your provider, your fund manager directly on what's being done from there. But in terms of bringing all your investments to New Zealand, we would probably look at that as not being safe, not being diverse, because you are too connected to the scene here in New Zealand, and you want some spread. You want to spread that risk between different geographical areas so that if some do well and some do less well, that you actually are balanced out, and your future is not tied directly just to one economy.
Cool. Thank you, Tom. So we're pretty much out of time. So we try and keep these short and sharp. So I guess just a final one, Tom, do you just want to give everyone just a quick snapshot of what's happening in Money Week, which is coming up next week, apart from that fabulous Mindful Money seminar on Wednesday the 12th. What else is happening during Money Week?
Yeah, so for those of you who haven't heard, next week is Sorted Money Week. It's the week with a lot of stakeholders who participate. You know, whether it's the banks or educational schools and universities, and the private sector, public sector, nonprofit. They all come together, and what we're trying to do this year, the theme is just wondering, because with all of the change that we've been through recently, people are very much more engaged with their finances, but a lot of questions are coming up. And so what we'd like to do is create a safe space throughout the country in order to really let people raise their questions about money. And so Just Wondering is the campaign there, and we're really, it's a call for money questions. And it's a call for a lot of us to help with the answers as well, because each of us, you know, has a lot of expertise to bring to the table. So we're trying to facilitate a call for questions and for answers to get out there. The website is sorted.org.nz/just wondering. And so we're really keen to know what you're wondering about. And every question, especially about money, is a good question.
Very good, Tom. I'm sure you're going to get thousands of questions. You're going to be spending the next year answering all these questions, doing nothing else in your weekends.
Luckily, we've got a good team
questions.
that's at the ready. And we also have a panel of experts. If any come up in the ethical space, I know who I'll be calling, Barry.
Oh, yeah. No problem at all. We'd love to.
That'd be great.
Well, thank you very much, Tom. Lovely to have a chance to talk. Thanks to everyone on the call and those listening to the recorded version of this. As I said, there's a conference coming up next Wednesday. The other thing is there are YouTube videos of all of these on our website. So all 15 online seminars on the Mindful Money website. And we've also got a sort of written summary of each of the seminars. And we'll be doing one for this one as well. So check out the Mindful Money website to have a look at those online seminars. There's some fantastic ones. One on alcohol last week was absolutely dynamic. It was fantastic. We had the head of the Financial Markets Authority on the week before, Rob Everett. Really interesting session. In 2 weeks or next week, we've got the conference. A week after that, we'll be talking about some particular companies. And then we've got Matt Winneray from the New Zealand Super Fund. So that'll be a great interview. And then James Shaw the week after that. So 2nd of September with Minister of Climate Change, James Shaw. We did invite other political parties as well, but James was the only one who decided to come along. So it's not long before the election, so maybe some people want to come in with a few political questions as well. Thanks again, Tom. Thank you all for participating, and we'll hope to see you at this time in future, except for next Wednesday at 5 o'clock. Thank you very much. Thanks very much to our sponsors, Booster, Harbour and Generate, fund managers who've been fantastic in their support of these events. So we're very grateful. And I'll see you all in future, I hope. Thank you.